S&P and NASDAQ, as we've been discussing, coming off a week of gains, with the latter trying to hold on to gains for the month of April. Our next guest says it's no longer inflation, but growth that investors should be worried about here. Darrell, Cronk, Wells Fargo CIO for Wealth and Investment Management, joins us here at Post 9. He recently revised his year-end S&P target down from 6,600 now to 6,000. Darrell, good to see you.
You too, Mike. Thanks.
So growth is the issue. If you think we have a path back towards 6,000, not a bad move from here. What does it mean for the underlying economy? What are your assumptions there?
Well, I think you do have to get. Obviously, we're going to get first quarter GDP growth, right? We're going to hit stall speed here in the first and second quarter, right? I mean, there's just no ifs, ands, buts to the conversation you were just having. Even if you restarted those supply chains and that inventory ordering tomorrow, you've already inlaid basically a 30 to 45 day air bubble, right, in a lot of that shipping. You see it in the shipping containers down 60% coming out of China. You see it in the trucking rates starting to fall off meaningfully, right? You look at the Port of Los Angeles and some of the data that they're putting out already. That will cascade kind of west to east across the country. So you've got to have the economy pick up in the second half, right? You need earnings to deliver. You need inflation not to get, wieldy and out of control here. Remember, I think what a lot of people forget is we always talk about tariffs being inflationary, which they are, but they're blunt force resets in prices, right? They're not sustained inflationary out over the time. So yes, you've got to be able to absorb that blunt force, reset of prices and the impact of margins, but it's not like year 2, year 3, year 4, you continue to see the rate of change of inflation meaningfully move higher, unless, of course, tariffs move meaningfully higher over that period of time.
Well, this brings us right into, I guess, the Fed debate and sort of how markets will adjust their assumptions of what policy might be able to do in that context. I mean, does your expectation that we have some upside by the end of the year to stocks imply that the Fed can be proactive, or that we're not going to count on too much from there?
Yeah, if you line up, so obviously we know the president's been kind of screaming at the Fed to cut interest rates, right? But it's not just the president. The bond market is too, right? Mm-hmm. Look at the 2-year Treasury at 3.75, right, versus a Fed funds at 4.33, right? It's pricing in those 3 cuts. We agree with that. We think the Fed needs to do that. Now, Fed cuts over a period of time are important, but if the Fed showed up tomorrow and did some type of an emergency cut or whatever, markets I don't think would perceive that very well, Mike. I mean, that would be perceived as like, they're seeing things that we're not seeing. Growth scare is more pervasive and more problematic. So I think the Fed has to be really careful here about how they act.
I mean, I don't think people are suggesting an emergency cut or cut this meeting, although the president would like to see that. But what if they change their posture a little more dovish, speaking like the ECB about downside risks to the economy? Because it feels like they've been more worried about inflation.
I agree, and they've been consistent in those comments. So if they switched it to more growth concerns and less inflation concerns, I think that would be perceived by markets as more dovish. I mean, you just saw the Fed president out saying he thinks June could be on the table potentially at the end of last week for a possible Fed rate cut. So they're starting to lay that groundwork. Obviously, we're in a blackout period for them this week and going forward, but we'll have to see how they start to change that narrative. If they do and become a little more perceived dovish, I think markets would perceive that well in a well-timed, thoughtful way.
You mentioned earnings have to come through. How much confidence do we have that that's going to be the case? It's funny because as much as the attention, understandably, is all on global trading goods, that's not necessarily like the key swing factor of S&P earnings.
I agree completely. And look, I mean, if you look at since April 1st, 9 of the 11 S&P GIC sectors have revised guidance lower. The problem is, out of what we've seen of, let's say, 25% earnings so far that have been reported, less than 20% of them have been willing to give forward guidance.
Yeah.
Right. So obviously the guidance suspension is really problematic and important here. So that means they just have to deliver. Your point about you need consumer discretionary to hold up, you need industrials to hold up, and you need tech to deliver to really make those next meaningful leg higher. And to your earlier point, we've got to push through kind of the downward sloping 50-day moving average at 5640. Yeah. And then you bring into conversation the 5800, which is the 200-day moving average, and do you believe at that point?
Yeah, which is coming down a little bit each day. So We'll see where it all comes together if we continue to rally here. Darrell, good to see you. Thank you.
Thanks.